Imagine you retire on January 1st. Champagne, balloons, maybe a little dance that your knees immediately regret. You've got $800,000 saved. You made it. And then, the stock market drops 35% in the first year of your retirement. Suddenly, you're watching your nest egg shrink while trying to live off it, selling shares at a loss just to cover basic living expenses. The market recovery comes eventually, but by then, you've sold so much at the bottom that you barely benefit from the bounce back. In financial literature, this is known as sequence of returns risk. It is one of the most critical challenges in long-term retirement planning. Today, we are going to break down an educational framework often studied in financial literacy, the three-bucket strategy, a structural approach designed to help navigate market volatility. Let's get into it. Here's something worth reflecting on. Research consistently shows that a majority of retirees enter their post-work years without a structured withdrawal plan. They spend decades focusing entirely on accumulation. But when retirement actually arrives, the strategy often becomes, "I'll just take money out when I need it." Traditional models, like the classic 60-40 stock and bond allocation with a 4% withdrawal rule, are based on historical data. However, they don't eliminate the core timing risk, retiring right before a market downturn. You cannot control when the market drops, but you can control your portfolio structure, and structure is precisely what the three-bucket strategy provides. The core idea is straightforward. Not all of your capital needs to perform the same function at the same time. Think of your retirement funds like a water flow system. You need consistent monthly and yearly support, regardless of external market conditions. Bucket 1 is your present liquidity. Cash, highly accessible, allocated in assets that carry minimal capital risk, such as high-yield savings accounts or short-term government instruments. The general guideline in financial literacy models is 1 to 2 years of living expenses. If monthly expenses are $5,000, you maintain $60,000 to $120,000 in Bucket 1. Why does this matter? Even if markets decline immediately upon your retirement, you are not forced to liquidate investments during a downturn. You have a runway. That behavioral buffer helps maintain emotional clarity. Bucket 2 is your intermediate income bucket, covering years 3 through 10 of retirement. This segment holds instruments like bond funds, dividend-paying assets, and laddered certificates of deposit. The objective here is stability and predictable income generation rather than aggressive growth. Bucket 3 is your long-term growth engine, invested for maximum potential, such as broad market index funds and global equities. Because Buckets 1 and 2 cover your intermediate needs, Bucket 3 never has to be touched during a market contraction. It has the time to ride out volatility and recover naturally. If you find these structural frameworks helpful for long-term planning, consider subscribing. Every week we examine the mechanics and data behind resilient financial models. Now, let's look at how the entire system interacts. Think of the three buckets working together like a waterfall system. Bucket 3, at the top, grows during favorable market cycles. When appropriate, gains are skimmed to refill Bucket 2. Bucket 2, in the middle, generates regular income through dividends and interest, which flows down to replenish Bucket 1. Bucket 1, at the bottom, funds daily living expenses. Let's look at a practical model. Retiring at age 65 with $900,000 saved and monthly expenses of $5,000, or $60,000 per year. Bucket 1, 1.5 years of expenses, or $90,000 in liquid accounts. Bucket 2, 5 years of expenses, or $300,000 in income-generating instruments. Bucket 3, the remaining $510,000 allocated toward diversified growth assets. If markets contract in year 1, reducing Bucket 3's paper value temporarily, you are fully insulated. You don't touch Bucket 3 because your lifestyle is already funded by Buckets 1 and 2. By the time you eventually need it, historical data shows markets have ample time to recover. Let's review the most critical errors and design flaws frequently observed when individuals implement this structural framework in real-world scenarios. First, making Bucket 1 excessively large. It is completely natural to seek safety, especially during transitions into retirement. However, Holding 3, 4, or even 5 years of living expenses purely in cash or traditional savings exposes your capital to significant inflation risk over long time horizons. Cash provides immediate liquidity, but it is not built for wealth preservation against rising consumer prices. Keep Bucket 1 lean and purpose-driven. Typically 1 to 2 years of net living expenses is more than enough to maintain psychological stability without dragging down overall performance. Second, making Bucket 3 overly conservative. The primary function of Bucket 3 is to act as your long-term growth engine. If you populate this bucket with short-term bonds, low-yield money market instruments, or cash equivalents simply because you dislike seeing temporary red numbers on a screen, you neutralize the fundamental mechanism of the strategy. The absolute reason you establish Buckets 1 and 2 in the first place is to build a time buffer. That buffer gives Bucket 3 the necessary time to withstand short-term market volatility and deliver real equity growth. Trust the structural segregation. Third, neglecting systematic annual rebalancing. A bucket strategy is not a static setup that you configure once and ignore for a decade. Market movements naturally alter your asset weights over time. During strong bull markets, Bucket 3 will expand significantly, requiring you to systematically harvest gains and replenish Buckets 1 and 2. Conversely, during prolonged bear markets, you intentionally pause rebalancing to let Bucket 3 recover. Portfolios require structured periodic reviews, ideally once a year, to keep allocations aligned with your evolving horizon. Fourth, completely overlooking external guaranteed income sources. If you receive guaranteed payouts from Social Security, corporate pensions, or rental properties, those cash flows directly offset your baseline living costs. For example, if your total annual lifestyle cost is $60,000, but you receive $24,000 annually from Social Security, your buckets only need to generate $36,000 per year. Building your entire portfolio layout around gross expenses instead of your net income gap leads to over-allocating funds unnecessarily. Fifth, abandoning the plan during periods of heightened market panic. You can construct a flawless structural architecture on paper, but if you panic and liquidate growth assets at the bottom of a cycle, the framework fails. The entire psychological purpose of this model is to remove emotion from execution. The 3-bucket strategy is not about predicting market bottoms, guessing interest rate shifts, or timing economic cycles. It is a practical educational framework designed to systematically manage timing risk and preserve long-term capital efficiency. It removes the ambiguity from retirement distribution. Bucket 1 gives you immediate liquid security, so you never have to sell assets at a loss. Bucket 2 bridges the medium-term gap with dependable income-generating instruments. Bucket 3 unleashes the compounding power of broad market growth, fully insulated from short-term market noise. When these components operate in harmony, they form a resilient, self-sustaining financial ecosystem. It protects your lifestyle, shelters your long-term wealth, and gives your portfolio the precious gift it needs most: time. Thank you for watching, stay disciplined, and see you in the next analytical breakdown.